LNG ships, so basically carrying gas from Qatar to Europe, we're basically at zero. So it cannot get any worse. It can only improve from here. And quite interestingly, it seems like natural gas prices at the producing end of the equation, so in Qatar and in the US, for example, you're listening to Macro Sunday, hosted to the weekly Macro Sunday podcast in another melt-up week. We've had tremendous returns across assets, including crypto, over the course of the past week. And it seems like there's a cyclical rotation underway. My name is, as mentioned, Andreas Steno, and I'm the founder of Steno Research. And as per usual, I'm joined by partner in the company and the head of geopolitics, Mikkel Rosenvold. Welcome to you.
Thanks a lot.
Wearing a shirt today. What the fuck is going on, Mikkel?
Not really in line with office politics, but no. Yeah, it's Friday. We're recording on a Friday.
Yeah, we are recording on a Friday. Let's just mention that, given that we're going to discuss, among other things, whether we'll have peace in Israel-Gaza on Monday, basically. Yeah. And, well, by the time of the recording, we don't know. And it will be very interesting to see whether Joe Biden's early promises of a Monday peace will come into fruition or not, Mikkel. In 10-15 minutes' time, we're joined by Tracy Shuchart of Hilltower Resource Advisors to discuss the commodity markets in light of everything that's ongoing in the Red Sea and in Israel. If we're amidst a cyclical rotation and sort of a repricing of global growth, the big question is here whether you own enough commodities in your portfolio, I think, because commodities have been battered left, right, and center through 23, but we're starting to see signs of an improving sentiment. But Mikkel, let's start with the political discussion sort of behind the surface of this move in markets. We've seen oil trading with probably a geopolitical risk premium due to this ongoing conflict in the Middle East. So first of all, will there be a conflict in a couple of days from now? What's your take on this peace process?
I think so. I've been a bit too optimistic about this, but I think we're getting very, very close to a ceasefire in Gaza. It appears that a deal is more or less in place. Netanyahu and the Israelis are still holding on and still trying to carry out some last offensive maneuvers inside Gaza. But there's not really too much left to attack in there. There's not too much left of Hamas to destroy, basically, other than the idea of Hamas, which they can't really destroy physically. So I think when Biden promises that we're getting close, we are getting close. And the timing is, of course, important. We'll get back to perhaps oil prices in the Red Sea, etc. So we're very much focused on the timing and getting that right in regards to our oil bed.
So, Mikkel, let's assume that we get a peace deal, or at least a ceasefire by early next week. Where does that leave the situation in the Red Sea?
That's the big question. I mean, just one more point. I think what's definitely the cutoff date is going to be the holy month of Ramadan in early March. It seems like the Israelis have more or less agreed to let that be a ceasefire period. So that's one date to look for. I believe it's March 10th. With regards to the Red Sea, I've said all along that I believe the solution to the Red Sea crisis lies in Gaza. A lot of people disagree with this. They say, oh, this is all Iran driving this. But at the end of the day, it is the Houthis firing these missiles. And they have always used the Gaza conflict as their casus belli, their reason for attacking ships. Over the past weeks, once we learned that Hamas are studying concrete ceasefire offers, we received some signals from both Hezbollah and Houthis that they are going to decrease the intensity of their attacks or cease them altogether once a truce or a ceasefire is signed that Hamas agrees with. So they followed Hamas into the war. They're going to follow Hamas out of this war. So once a ceasefire is signed, that's not going to be the end of the Red Sea attacks, but it will come relatively soon after if Hamas is satisfied, so to speak. Does that mean that global shipping will return to the Red Sea? Not immediately, but at some point, some shipping company will try, and once one company does it, the other pretty much have to follow to match that cost saving. So I think that is peace in Gaza is the beginning of the end of the Red Sea crisis as well.
And if we look at current statistics on crossings in the Suez Canal of, for example, LNG ships, so basically carrying gas from Qatar to Europe, we're basically at zero. So it cannot get any worse. It can only improve from here. And quite interestingly, it seems like natural gas prices at the producing end of the equation, so in Qatar and in the US, for example, they've basically sold off those benchmark prices due to the lack of shipping capacity transferring that natural gas to Europe or to elsewhere. Yeah. So I'm currently kind of interested in this peace talk because I'm not sure that natural gas prices will drop, but I'm pretty sure that oil prices will drop.
Exactly.
And it's kind of driven by oil not being a regional market, while nat gas is a regional market to a large extent. But Mikkel, speaking of politics, both Joe Biden and Mr. Donald Trump visited Texas over the course of the past couple of days. This is obviously related to the border question. And before we discuss this border question and the ramifications for the labor market policies in the US, let's listen to both Donald and Joe Biden in Texas.
We can do it together.
The United States is being overrun by the Biden migrant crime. It's a new form of vicious violation to our country.
There's no red state or blue state where I come from. They're just communities and families looking for help.
This Governor Newsom from California, isn't that his name, Newsom? What he's done to California is unbelievable.
So instead of playing politics with the issue, why don't we just get together and get it done?
But this is a Joe Biden invasion. Horrible. Crooked Joe is the blood of countless innocent victims.
Compromise is part of the process. That's how democracy works. That's how it's supposed to work.
We did much better in 2020 than we ever even thought about doing in 2016. And very bad things happened.
We work for the American people, not the Democratic Party, the Republican Party. We work for the American people.
Nobody explained to me how allowing millions of people from places unknown, from countries unknown.
Yeah, this is obviously Donald referring over and over and over to the amount of illegal immigrants that we've seen basically over the past, say, 24 months. And this is quite visibly something that has accelerated. So, Mikkel, this border issue formed part of the discussions around financial policy, actually, in Congress over the past couple of months. But it was kind of used as a bargaining chip, in a sense, between the Democrats and the Republicans. But we're still seeing inflows. So what's actually true here and what's not true related to this story?
I think you could argue that both are right. I guess that's the boring answer. I mean, it's true that immigration has flared up under Biden, and the problem, if you read it as such, has not really been solved. On the other hand, it's true what Biden says that they are trying to pass bills to amend the border issue, and that's being blocked because it's being connected to all these other situations, to Ukraine, to Israel, to the budget deal. I mean, that's the European model. We've been used to that for decades in Europe, especially here in Scandinavia, to link budget talks with immigration policy. But it's a new thing in America. I think it's also connected to the new role of the U.S. government, because we've had over the history, the U.S. have had massive immigration waves, but they haven't really come with drains on the federal budgets. They are now through various welfare programs and in general increased government spending. So there's a feeling that the more people get in, the more we have to feed and pay them, and that obviously breeds some resentment. And this is an issue with relatively wide support in the U.S. electorate. That's why both Trump and Biden goes down there, and that's why it's beginning to be tied to a lot of other processes, because this is sort of a trump card for at least for Trump. We'll see about how if Biden manages to spin this. So it's interesting. It seems like the U.S. has become an anti-immigration electorate basically, and that's that's going to be a driving force for U.S. politics for the coming decades.
It certainly will be a driving force, Mikkel. And if we look at the ramifications for interest rates, financial policy, and monetary policy, the interesting thing here is that the Federal Reserve basically keeps on communicating that the labor market is coming into better balance, to use the exact phrase of Jay Powell. And if we look at labor market developments over the past 6 months, maybe even 12 months, we've seen a clear tendency towards early retirements again, especially with the ongoing gains in crypto and technology space in assets. So basically wealth effects allow people to retire early. On our estimates, we're talking about plus 3 million on aggregate since the pandemic now in early or excess retirements. And you obviously need to replace that labor force with someone else. And therefore, the big question here, if I am allowed to don my tinfoil hat for a second, is whether the Biden administration allowed this immigration on purpose to try and bring back balance in the labor market in the US. What do you think about that thesis?
Yeah. The dynamic is true. I don't think the intention is true. I don't think that this has ever been an intentional policy. I don't think it has been in Europe as well, and not to the extent it is. But it is basically what's happening. I mean, and it is what is keeping a lot of the American economy afloat. Basically, this access of new, young, work-willing and relatively cheap labor coming into the economy. That is a huge factor of the U.S. economy doing so well. It's been keeping up. It's basically the same case in Europe to some extent. We've had a lot of large amounts of labor coming in, both from North Africa, the Middle East, and from Eastern Europe as well, which has helped the Northern and Western European economies immensely.
If we look at the wage growth right now in the US, I think it's fair to assume that it's trending between 5 and 6% annualized. And some of the signs that we get from small and medium-sized corporations and companies in the US, they point to compensation plans rising now, assuming that the border issue will only grow in significance ahead of the November election, and assuming that we actually get a complete shutdown of illegal immigration or something close to that. It seems like wage growth will be rising again this year, Mikkel.
Absolutely. I mean, the constant supply of new labor is a force keeping wages down. So if that's cut off to some extent, you are going to see beginning labor shortages across America, as we have in some parts of Europe as well. So that is the long-term dilemma of this. That is the Japanese dilemma, basically.
Yeah, it is.
How do you keep an economy flowing if everyone is retiring?
Yeah. My good friend Thorsten Sluk from Apollo, he wrote an email to clients of Apollo and to subscribers to his newsletter service, stating that the Federal Reserve will not cut interest rates in 2024 because of this immigration issue sort of declining in size, meaning that wage growth could increase. That's at least one of his arguments. He sees a reacceleration of the US economy. He sees an inflation pressure on the rise again. It's basically everything we've said over the past quarter. And as I wrote to clients last weekend, Mikkel, when I traveled hedge funds on a couple of trips in December of 23, stating that the next move from the Fed could even be a hike, I was considered a madman, and I'm not sure I'm considered a madman today. I know we've had stuff wrong since. It's not. I'm not trying to sort of come across with the message of being right always, but this has been one of my key pushbacks towards markets this year, and oh boy, it's been right. So if you want to check out our view on dollar inflation, dollar wage growth, and why we think it's impossible to get dollar inflation back to 2% this year, go check it out on stenoresearch.com. Mikkel, we talked about the impact on oil and natural gas from this conflict in the Middle East. And I think it's about time to invite Tracy Shuchart to the Macro Sunday podcast. She is the CEO of Hilltower Resource Advisors. She's been working with commodities for decades, and she's one of the most sought after strategists on namely commodity developments. And as per usual, we introduce our guest of the week with a soundbite from a piece of music. And given that we're going to talk about commodities and mainly energy commodities, Mikkel, here's the band called Chase with Black Gold.
steel toes, big dreams, big goals. Working for the money, working for the honeys, working for the gold, working for the folks back home. Let's go now, black gold, steel toes, big dreams, big goals. Working for the money, working for the honeys, working for the gold.
It's now my great pleasure to introduce Tracy Shuchart of Hilltower Resource Advisors to the Macro Sunday podcast. Tracy, it's such a pleasure to host you. Thank you for joining us here at the show.
Absolutely, my pleasure.
Tracy, we've seen a pretty decent price action in oil markets, say over the past 4 to 6 weeks. And currently we're kind of in the negotiation process, it seems, around a ceasefire in Israel, Gaza. So how important do you find this potential truce in the Middle East to be for oil markets over the next couple of months here?
Well, I think really this has to do with the tanker market more so than the oil market in general, right? Because Israel is really a natural gas producer, not an oil producer. And so really what we haven't seen oil prices really reacting to this much, in all honesty, since October, but we have seen the tanker market react to this as soon as they stopped transiting the Red Sea. And so I think that even if there is a truce, I'm not sure that's really going to affect oil prices that much, since they have largely been unaffected by this conflict.
So speaking of the Red Sea, you mentioned the Red Sea as an important driver of energy markets currently. And if we look at crossings through the Suez Canal, for example, of LNG and oil tankers, we're currently stuck in a situation where transits are close to zero, right? So how important is this shipping malaise for commodity markets currently, and how do you expect the shipping impact to sort of play out over the next couple of months and quarters here?
Well, I think what we saw first, it was happening with container ships, right? And they stopped transiting the Red Sea because they were the kind of the first ones attacked. Then we saw tankers, then we saw grain ships. And so right now, largely what we're seeing dry bulk carriers, which carry grain, and containers, and oil product and oil tankers all avoiding the Red Sea, unless they happen to be going to Iran, which is not surprising. But so I think right now that's largely impacting Europe right now. And I think it's only a matter of time until we start to kind of see this supply chain disruption come to shores in North America.
So when we look at the issue of lack of safe shipping lanes in the Red Sea, it seems like there's a time lag between the lack of safe transits until we actually see the price action and the spillovers to the price of goods and commodities. So how long is this time lag? Is it possible to actually gauge for how long we need to wait until we see the price action?
Well, I think it's rather difficult. Again, we are already seeing this time lag affecting companies in Europe. We had, some big companies such as Next and IKEA say that they're expecting delays because of the extra transit time around the Cape of Africa. And so if we're looking at North America, that's going to take probably another month or two. So I think we'll really start seeing this price action become more deep, so to speak, for Europe within the next month or two. And then it'll take probably till summer for that to really flow into North America.
And when we look at the lack of safe shipping lanes, we also need to discuss the ramifications for energy markets overall. If we look at the oil market, we've discussed how the impact is probably larger through this indirect shipping channel than directly from the Israel conflict. But if we look at nat gas, it may be a different question. Currently, when we look at nat gas benchmarks in the US, we're almost back to the early innings of the pandemic during the lockdowns. What do you make of that price action in nat gas space? It seems like we're close to almost historical lows here.
Well, I think that, it took a couple of years for all of these supply chains to kind of switch up, right? And so, particularly from Europe, going from piped gas from Russia to being a large import of LNG, particularly from the United States. The thing that the thing with nat gas prices right now is what we're seeing is, Europe is 62% full right now, which is highs for this time of year. In fact, they're even looking to store gas in Ukraine right now because they need excess storage right now. And then if you look at the US, our wells are getting gassier and gassier. And so we're producing a lot more gas as a byproduct of oil wells. And so we have a lot, and we don't have enough exports regions right now. And, and of course, when we had the Biden administration come along and say, we're going to pause export licenses, that certainly didn't help market sentiment.
So when we look at the export opportunities for U.S. shale producers, Europe is obviously one important export destination, and currently we are seeing the first signs of pretty clear acceleration of the U.S. economy. That's at least seems to be the consensus. But what about the demand for energy products outside of the U.S.? Do you sense a cyclical upswing outside of the U.S., or is it solely a domestic story for now?
Well, as far as energy prices are concerned, or natural gas prices are concerned, that's a domestic problem. But if we look globally, even though we are seeing a slowdown in manufacturing, particularly again in Europe, we are seeing an acceleration of natural gas demand in particularly Asia. And so that's kind of offsetting the decrease in demand from the European markets at this point.
And Tracy, when we look at the amount of natural gas produced in the U.S., it's obviously related to that spike that we've seen in oil production, basically since OPEC started, limiting their own supplies. So, what do you make of this talk of war between OPEC and the U.S. in terms of production here? It seems like the OPEC group is still keen on keeping production low into spring here, but do they have the guts to continue to do so here?
I actually think that they do. And I think that, again, I think they're not worried about this competition from the US as they once were when we first started seeing the shale boom, right? I don't think they're the mere fact that they're choosing to keep these cuts shows that they're not really concerned about this spike in U.S. production. I would happen to agree with them. I think this spike in U.S. production needs to be investigated further because really, again, we're producing gassier and gassier wells. And so that means you're producing a lot of stuff that really can't be used for gasoline or distillates or things. It's mostly lighter oil that you really can only be used for chemical processing. And so there is a huge market for that, absolutely, but it's not really that big of a threat for OPEC oil, which is a little bit heavier and used for more of the traditional means of oil production, oil refining.
So, Tracy, is it a fair assumption to make the case that U.S. production is very close to peak levels here? I mean, can we get positive supply news out of the U.S. from this point?
I believe that we are going to see a decline. If we look at Genscape data, we're already starting to see a decline. The U.S. EIA information is 2 months lagging, and they've added kind of a different stipulation for these lighter oils. So the data is kind of skewed right now to the upside. But I do think that we are, and if we look at all the M&A deals that we're seeing in the United States, oil companies don't want to invest more to produce more. They're buying capacity, right? And so that's why you see all these big majors kind of eating up these middle to low end guys, because they're just, instead of it more capex into capacity, they're buying capacity. And so I think that we have hit a point that we will start to see declines.
And given that China is obviously a major importer both of energy but also industrial metals, we kind of have to pair that supply view with a demand view, especially in China. And if you look at the Chinese demand now, you touched upon the Asian demand being on the rise for energy products, but do you see sort of an overall picture of improving demand side dynamics in China here, or where do you see things headed?
Well, I think it's really interesting when we talk about China, because I think I think their economy is slowly on the decline. You're not going to see these, 7, 6, 5% GDP growth per year anymore. And they kind of hit a peak. But I think that the markets are too focused on China, because they have been for the last 20 years. If you're looking at oil, natural gas, or metals demand, everybody looks to China, right? And their demand actually, their 2023 demand for oil is the highest ever. But when we're talking metals, that was, because their manufacturing is on the decline, it's we've had a disastrous fall from a lot of these critical minerals since summer of 2022. But I think that really we need to stop looking at China, and we need to start looking at other Asian nations where we're seeing extreme growth that people are kind of not looking at right now, particularly in India and Indonesia and Vietnam. And we also have to start looking at Africa as well. And so I think the market participants really need to kind of adjust where they're looking at right now and not be so dependent on China for demand for all of these products.
So if we try and pair the global supply picture with the global demand picture for energy products and other commodities through 24, Tracy, do you think people own enough commodities out there from a portfolio perspective, given this discussion? I mean, the supply side seems to be relatively tight still, despite the ongoing positive surprises from the US, and there are signs of positive demand both in Asia and elsewhere. So, what do you make of the commodity investment case in light of this?
Well, I personally think people are very underweight commodities at this point, because I think it's only supposed to grow. And even if you look at the projections for, this green transition, even if we only get a third of the way to where these projections lead us, we still don't have enough metals and enough energy to grow this. And I think that people are overlooking that right now. And I think, perhaps the AI trend is on the forefront of everybody's. And so everybody's, it's a jump back into the tech sector into growth. But I think that still the commodities industry is generally very overlooked right now, and hard assets are generally overlooked right now. And I think you're kind of beginning to see this if you look at precious metals right now, right? If you look at gold and silver, even despite all of these projections of rate cuts, et cetera, we're still seeing these prices accelerate, which is a very odd picture. And so it seems to be that people are worried on kind of the back end. But yes, in some, I definitely think that people are underweight commodities in their portfolios right now because it's just not the trade to be in right now. The trade is to be in growth.
Yeah, I think you're absolutely spot on, Tracy. And if we look at various positioning gauges, they would agree with that assessment. Both the CFTC data and also the monthly fund manager survey from Bank of America basically get to the same conclusion that commodities are very underway, also from a historical perspective. Tracy Shuchart from Hilltower Resource Advisors, it was a pleasure to host you at the Macro Sunday podcast, and we hope to see you back at the show through the remainder of the year.
And thank you for having me. I enjoyed it very much. Thank you.
Working for the gold, working for the folks back home. Let's go now.
So we're back in the studio from the interview with Tracy Shuchart of Hilltower Resource Advisors. And Mikkel, it was great having Tracy on the show. And it's always great to talk about commodities. It's I think it's a theme that we do not cover enough currently, especially given the early signs or the green shoots in global manufacturing. It seems like the manufacturing pace is no longer slowing, at least. And that is probably the theme that you should worry the most about in your portfolio right now, if you ask me. So, Mikkel, you've been arguing that a peace deal is negative for oil. And obviously it relates to sort of the geopolitical risks surrounding the oil case.
The risk premium basically being pulled out of the price would be my argument,
So, Mikkel, what are you going to watch? Let's assume that we get this peace deal. What would be the sort of main political scenarios to watch in relation to oil and other energy products in the weeks to come? Are you staring at the Houthis here or Iran? What are the main sort of sources of risk here?
Yeah. Obviously, one risk is how Iran deals with this, because the peace deals or the alleged models for ceasefire that we're looking at the moment is some sort of collaboration between Egypt, Saudi Arabia, the Gulf states, and Israel. And that's exactly what Iran wanted to avoid and why they perhaps pushed Hamas to initiate this war. So it's very important that this ceasefire includes the Palestinians, includes some sort of solution that they're satisfied with. Otherwise, we might see Iran initiate new attacks. So that's one thing. The other thing is, will the Houthis keep their word and stop attacking shipping? Because the reopening of the Suez route is key to this. It's key to Egypt finding themselves a bit more at ease. They're losing a huge amount of dollars right now, and that's two main things to the main risk areas to watch at the moment. Then obviously in the longer term, it's interesting to see the role of OPEC. Will OPEC survive in its new larger form with Brazil and Russia? Can they get cohesion? Can they control prices as much as they want to? In my opinion, their influence or their power over oil prices have diminished because of the US and to a lesser extent China emerging as major producers and with major stocks that can influence prices just as much as OPEC cutting production. So the role of OPEC, this perhaps a bit more well-functioning oil market to some extent with less cartel like behavior from OPEC is something that could keep oil prices a bit more stable in the future, in my opinion.
Yeah. So we traded oil on the long side for I think it was mid-January, and so far we've earned a decent return on it. But I tend to agree with you, Mikkel. From a risk-reward perspective, it seems like we're edging towards the end of that trade. I'm much more into the nat gas trade right now, also from a nominal perspective, probably even to an extent that I shouldn't be. I guess the nat gas trade was the divorce trade number one in 23, right? It was one-way traffic down. I think we're up roughly 10-12% since entering. But that's
You've
basically
been happy this week at the office.
but that's still like a one-day volatility in that trade.
Very much.
Point being here that when we look at nat gas, it's quite interesting that we see very low sort of pass-through of LNG ships, both in the Panama Canal and in the Suez Canal. So we're talking about delays. We're talking about Qatar, for example, mentioning that the lack of safe shipping lanes is an issue for their exports to the Eurozone. And we know that everything related to shipping always sort of arrives with a lag of, say, 4 to 6 weeks at least. And therefore, this complete sort of diminishing trend of LNG crossings in the Suez and in Panama, which we've seen basically since New Year, I'm not sure that we've seen sort of the full scale ramification of this in Europe, for example. We will see fewer ships arriving in Europe over the coming weeks, which could lead to a new wave of orders, basically. So I'm kind of split here on whether energy will perform as a group or not. But I probably agree with you that you need to buy nat gas and not oil in this story, if anything. And Mikkel, it always, when we're talking energy, it always relates to interest rate markets as well, because energy obviously impacts inflation both directly but also indirectly. And it's kind of hard to find anyone willing to bet on rate cuts in the US right now. We've been banging the drum on rate cuts in the Eurozone. I don't exactly think that the inflation numbers from the Eurozone decided to play ball with that view over the past week. We still have sticky inflation in a couple of very wage-heavy components in Europe. But Germany is starting to soften quite substantially. And therefore, I mean, it still seems like the European Central Bank acts as sort of a deer stuck in the lights, in a sense. They do not dare to move ahead of the Federal Reserve, even though they should. And I think actual circumstances will force them to move first. But April, it's tricky now. Probably June. But the Fed will not cut this first half of the year. I feel pretty confident saying that. And then, Mikkel, we haven't even talked about China yet.
No.
So when we look at our equity trading book right now, let me just mention that in rate space, we're basically paid in dollar rates versus received in euros. The details are found in our portfolio on stenoresearch.com. But in equity space, we've basically leaned towards a comeback in China. Various proxies are used, but we're talking about exposures to emerging Asia. We're talking about exposures in materials. So, Mikkel, do you see signs of China improving here, or do you see China just sort of managing to avoid the worst case scenarios, at least?
Yeah, that's probably the first step. But I think there are signs that they're getting their production machine up and running again, and that will of course push to both energy and commodity prices. So I think that is the most logical scenario. They're still struggling, as we've talked about before, to get grasp of how to really engage their economy and how to manage it. As China is growing in the global supply chain or in the global value chain, but I believe the signs out there are looking positive. The government is going to fuel the economy more, just as we're seeing in Europe and the US, and that should push to both commodities, metals, etc., especially, and also energy prices. The link should be very direct to natural gas prices. Although we know that China have some back channels for especially for the energy supply. They're getting a lot of energy out of Russia, which operates in different terms basically than the world markets.
Yeah, and we've obviously seen a new set of sanctions recently imposed on Russia. Mikkel, we saw a relatively weak ISM manufacturing report Friday morning out of the US. I wouldn't put too much emphasis on that. It seems like all markets are sort of pointing in the direction of a cyclical improvement in markets. But one final observation I'd like to leave the audience with is that take a look at the consensus expectation for growth in 2024. The growth outlook for the United States is through the roof relative to expectations 6 months ago. If you look at the growth outlook for Germany or China relative to 6 months ago, it has rather declined further than the opposite. So expectations are nowhere to be seen in terms of the comeback outside of the US. This is a completely US-centric story so far in markets. And I think from a marginal perspective, the next relevant discussion is whether the rest of the world can catch up to a certain extent to this.
And I mean, and at some point they will. The US is still the driver of the global economy, in my opinion. And even though we're talking about decoupling of the US economy from China, I mean, higher growth in US means higher consumer spending. Higher consumer spending means buying more stuff from China. It still does. So even though the US is building more and also trying to friendshore, reshore activities, higher consumer spending means buying more stuff from China.
Yeah. And now that we talked about concrete trade ideas, being long nat gas, being long the cyclical rotation in equity markets, and by the way, in FX space as well, let's play our disclaimer. Here's Gennaro Gattuso.
Sometimes may be good, sometimes may be shit.
Gennaro is referring to the trade ideas of ours. Mikkel, once again, a pleasure to host you. We'll be back next week with the Fed guy visiting the podcast, Joseph Wang. It will be very interesting to hear his takes on the Federal Reserve ahead of their March meeting. Will we get that ultimate tapering of QT? Will we get signs of a lack of confidence in rate cuts? What should we expect from Jay Powell and his ilk? Joseph Wang is joining us next week for that discussion. If you want more free content from Steno Research, find the link to our free newsletter